Hi, I'm John Pasalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview.
Hi, Urmi Desai here, Head of Content at Realosophy and MoveSmartly.com editor. Next up at the summit is Will Dunning. Will is an independent housing analyst and economist, and his clients include industry associations, financial and government institutions, builders, investors, and others. Will has been analyzing housing markets since 1982. So I'm very interested to hear from Will about whether past experiences, past economic and housing downturns experienced in Canada can tell us anything about the current period of uncertainty we're in. Hi, Will. Great to have you with us at the summit.
I'm glad to be here, Urmi.
Will, writing in your latest Housing Digest, you've pointed out that economists normally look to recent data to help provide clues as to what might happen next, but that this hasn't worked so well recently. How has this been true for the recent housing market data we've been seeing?
Well, I don't know that all economists would agree with me characterizing that way, but it seems to me that's the main reason you want to look at recent data. I mean, it's interesting in itself, but what makes it important is if it gives you clues about what might happen next. So most of the time, data behaves reasonably well. What's happened recently provides an okay guide to what might happen in the next little while. But you look back at the recent data for February, March, April, May, and now June, and none of those months has predicted what did happen in the following month. And so now we've got data for June. Should we rely on June? And June's going to give us a reliable indication of what might happen in July? Well, it might. So far, it seems it's not bad. But is that reliable indication going to continue true? Are we getting signs now that are telling us reliably what's going to be happening in October? I'm guessing we're probably not getting reliable signs. So this is the way that I like to look at the data on sales. It's a time series presentation. It's looking at the data month after month. And it's the data from CREA. I've modified it a little bit. I just multiplied it by 12 and divided by 1,000, convert their numbers into seasonally adjusted annualized rates. So, I mean, I'm seeing a lot of information in this slide. What's most obvious is the very sharp drop that happened in March. And there was a partial recovery the drop in April, partial recovery in May, and a more substantial recovery in June. So, I mean, people can look at this chart and draw different conclusions. Some people would look at it and say, the market's taking off like a rocket, we're returning to a normal situation. Other people might look at it and say, well, if we take the average of the past 3 months, the average is only 50,000. And what we would expect is a normal month would be somewhere around 105,000 would be an average month at this time. So for the whole quarter, we're about half below normal. And that same person might say, even for the month of June, when we're up to 78,000, we're still about more than 20% below a normal level of activity. So yeah, there's improvement, but there's just still a long way to go. Some people will look at this data and say, well, the activity we're seeing for June is very similar to what we were seeing for the first half of 2019 and all of 2018. And so all is good. But then somebody might join to that, well, actually, the activity was very weak during that period because we were being heavily affected by the mortgage stress tests. So again, what we would hope to see is more like 100 to 105,000 as the level of activity. So, I don't want to get into an argument about who's right and who's wrong. I think something we can probably all agree on is it's going to be really hard to get a consensus of opinion about what's actually happening in the market now. Because it's the data we've got available to us, there's a vast range of conclusions people can draw. There isn't really an objective referee who can say, well, this is the right opinion. And taking the next step down the path, does this data we have now give us clues about what might happen over the next few months? Well, given that we can't even determine what this data means now, I don't think we can draw too many conclusions and get a real consensus about what happens next in the housing market. And besides which, there are a whole bunch of factors that are going to affect the market going forward that are totally unpredictable. As I think everybody can agree to that. There are a lot of unpredictable factors that are going to influence the future. So I think we can move on to the next slide, which is on the sales to listings ratio. So this is a pretty interesting slide. People talk about balanced markets and sellers markets and buyers markets. I hear people say that this ratio in the range of 40 to 60% represents a balanced market. I think that's too broad an interval to be using. So I've done some statistical analysis. My analysis says that at a sales to new listings ratio, 53%, we have a balanced market, in which prices would rise at about 2%. And so if we have a range of, an actual ratio in the range of 50 to 55%, that's a pretty healthy situation that balances the interests of buyers and sellers. And that's where we've been for the last 2 months, actually. So, from that perspective, we're in a good situation. Of course, it's a highly volatile situation in which there are artificial constraints on listings flowing into the market, and very artificial constraints on people making purchase decisions in the market. But from a very narrow perspective, we're in a good place now in terms of what might be driving price growth for the next little while. So now let's look at the next chart. That one, yes. So the average price is moving all over the place. There was a huge jump in the average price for June, both on a month-over-month basis and a year-over-year basis. But average prices can be really distorted just by changes by what's selling in the market. If there's a lot of high-end product selling in a month, that biases the price upwards. I think that's pretty much what happened in June. There was a big resurgence at the high end, distorted the average price. So I really prefer to work with price indexes, where clever people do a lot of work to figure out what's the trend that we can take out of all of these transactions. And Korea produces a really nice set of price indexes across the country and for different types of dwellings. So here we're looking at Korea's estimated price indexes for the GTA for just two of the categories, for single-family detached condo apartments. So what we're seeing here is during late 2019 to the beginning of this year, we were starting to see rapid growth of single detached pricing, which was the direct consequence of the tightness that had developed in the sales to listings ratio. The sales to listings ratio was very high in that period. We saw rapid price growth. And similarly for condominiums, very tight conditions in the condominium market resulted in very, very strong price growth actually for a period of years. Now, what are we seeing very recently? We've noticed that the sales to new listings ratio has fallen off sharply and it's in a balanced level. Lo and behold, these indexes are indicating that price growth has, the pattern has changed totally. We're seeing flat pricing for the last 2 months for singles, maybe even some price reduction for condo apartments. Now, I'm going to say, offering a defense to Korea that we're not asking for, but there's so much volatility in the data. I think it must be really, really challenging for Korea to produce these price indexes. And just because of the choppiness of the underlying data, there could be some choppiness in the estimates going forward. There might be a little bit of unreliability in the current estimates. But I think in general, I'm inclined to have a lot of confidence in the numbers I'm seeing in this chart. And what these numbers are telling me, in a situation that seems to be sort of balanced, we're sort of seeing price stability or something close to Toronto housing. So even though we're getting headline mentions of continuing rapid year-over-year price growth, that really has to do with the history that's getting increasingly old. really recent history is beginning to tell us a different story. And that's something that'll be very interesting to watch.
And that very rapid price growth we were seeing in as early this year as February, pre-COVID, of that 17% year over year. And now we're seeing a bit of a balance. And we've heard that when we were first in lockdown conditions, sellers stayed home and so did buyers, almost in lockstep. And so maybe that's giving us some of that, the price attenuation there.
Right, and they are returning to the market, and again, it's almost in lockstep, which is why the sales to listings ratio is shown on minor variations over the last few months. Listings have increased and sales have followed behind the listings.
And without getting into the technical details, as I'm sure I don't want to go beyond my pay grade, the difference with this way of looking at the data is that this will roughly try to take a house, for example, the baseline here is 2005, and try to compare a property that's similar to it over this time period. So to try and reduce the noise that you were saying of very high-end or properties or other things distorting what we normally look at as average prices, which tend to really reflect that distortion. Yeah. Is that a fair assessment of this kind of measurement?
Well, I mean, what they're doing is, to somebody like me, what they're doing is a really beautiful thing. They're doing a lot of stuff with the data they have to try to find central tendencies in really, really messy data. So they're trying to control for different features of the homes and making adjustments for that. That's something called hedonic analysis, having to do with pleasure, or the pleasure you get out of a dwelling determines its value. That's the basic essence. But they're also looking at sales, repeat sales of properties and what kinds of changes have happened there. And it's really very sophisticated stuff. And I love the data. What can I say?
So, following the onset of COVID, one of the most cautious forecasts for Canadian housing from the Canadian Mortgage and Housing Corporation, CMHC, which I believe you've also worked for a long time, it predicted
a really long time ago. Yes.
Really long time ago. Okay.
Left there in 1997.
Okay, so it's been quite some time. But their forecast now, we've spoken quite a bit about at the summit. It's predicting the top line, the media line was house prices falling up to 18%, and for it to take at least 2 to 3 years for a full recovery, with different cities recovering at different rates. Now, you've noted in your latest writing that forecast relies on a lot of assumptions, or key assumptions. Can you tell us more about these kind of assumptions?
Well, I mean, one thing I've been writing in quite a few different places is that any forecast you see today is not actually a forecast. It really is just a set of assumptions, and assumptions that more than anything tell us about the person who's making those assumptions rather than about the future. And I think of all the forecasts that are out there, every one of them is possible. Even though they're all, there's a huge range of different forecasts out there, ranging from very bullish and to very bearish from CMHC. So CMHC might be right, or they might be totally wrong. I'm not going to prejudge that. So I think what I'd really like to say is, rather than putting out a forecast, just a forecast, if people want to be forward-looking, should be talking about contingencies. So if X, Y, and Z happens, this is the outcome I expect. So CMHC is expecting an outcome, but they're not really telling us what are those X, Y's, and Z's that get them to that conclusion. I can guess at it. I could personally develop a similar forecast, making certain sets of assumptions. If I assume that all of the income support programs end, but they haven't seen an improvement in employment, then there's been a big drop in ability of people to buy homes, but also a big drop in people's ability to pay for their mortgages. So a further assumption I would have to make is the mortgage deferral programs fall off a cliff in October, and those mortgage deferral programs will not be extended. So if I assume those three things, catastrophic employment situation, no income supports, catastrophic situation of people having to pay their mortgages that they can't afford to pay, I can very easily get to a forecast of a very large drop in housing prices. But I'm not going to make any of those three assumptions. It's impossible. I believe it's impossible to make any assumption whatsoever, but it is very highly possible to talk about contingencies. If if this happens, then we might expect this. If something else happens, then this is a different outcome we should expect. So, I'm not trying to be disrespectful to anybody here. I would just like to see people messaging differently when they put a forecasts. Not talk about the forecast so much as what are the environment that they're expecting that we will be in for the effective period.
So your point being there that while it may be hard to predict exactly when employment returns to normal or income returns to normal, if we do see a prolonged drop off of both, there is an assumption that the government assistance programs will dry up when really we should be looking at several different scenarios about what might happen in response. So on that line.
Okay, I'd like to add one thing.
Yeah.
I put out this monthly report on the Toronto housing market called Housing Market Digest, which everybody should be reading, right?
Yes.
Everybody should read. It's only 2 pages. And in that report, I used to have as the final section, the forecast section. I took it out in March because in March I decided there is no point in forecasting in a situation in which it is impossible, confident about any forecast. So I am no longer putting any forecasts in my reports. But everybody should still read them. Come on.
I can attest to that. It's a great read.
Oh, thank you. Did I oversell a little bit?
No, I actually did think it unpacked that argument quite well. And to that point, so maybe we can think a little bit about how different actors might react to different situations. You have extensive experience consulting for the Canadian mortgage industry. I'm wondering if you might have any insight into how the industry might react. So if there is a prolonged downturn in employment and income, would the industry be able and willing to continue mortgage deferral programs? Do you have any views on that?
No, I don't. That's not something I'm qualified to talk about. I mean, the decision makers are, first of all, the government, whether they're supportive of it, and secondly, the very senior decision makers at the financial institutions, deciding whether or not it's in their interest, and in fact, if it's in their capacity even, continue building up these books of unpaid mortgages, and there may be some kind of need for instruments that help them. If there's a need for further deferrals, there may be a need for new financial instruments to help them fund those deferrals. There's a huge difference of opinions out there.
And so,
I think one thing I want to say is, I think the government has done a really amazing job in a very confusing environment, a very challenging environment, of very quickly engaging with the right people, figuring out who are the right people to engage with, get their opinions, and making decisions very quickly, and then adjusting decisions on the fly. This is not something we normally see from the government. Normally, policy change takes forever. Here we're seeing very, very rapid, pretty decent responses to policy needs on a daily basis. I'm mind-boggled in a very positive way by the way that the government is handling this. The economic file, for sure. This is phenomenal.
And continuing on that note of policymakers, you also make the point that housing has always been important to leading into and getting out of economic downturns. So it's not unreasonable to think that policymakers may undertake actions to bolster the housing market in the wake of COVID, as you mentioned. So the Bank of Canada's July rate announcement was accompanied by rather uncharacteristically boosterish language, with Governor Tiff Macklem encouraging us to, yes, go and get a mortgage because rates will remain low for some time. Now, is this the type of measures you are thinking that actors might do?
Well, I mean, that's the interest rate in these times is not the only determinant of whether or not a person can get a mortgage. There are the conditions of mortgage lending that matter. And those, unfortunately, have been restricted. And, I'm really puzzled by the changes that CMHC announced just a little while ago to make it more difficult for people to get mortgages. I mean, I've heard the rationale. I don't buy the rationale.
So you're talking about the CMHC's July 1st changes.
That's right. Right, to reduce the debt service ratios. Yeah. So we're in a situation where we're really going to be struggling to come out of this economic situation. And an important part of the economy is being deliberately hobbled by a government policy. I'm having trouble with that. And I'm waiting for the federal government to announce, no, that's not really the way we need to go now. Certainly the private mortgage insurers have said, from their point of view, it's not necessary to go there. Our businesses are quite strong with the existing policies. So I'm hard pressed why CMHC has to decide that it's essential and to create an impediment to economic recovery when the private sector is saying it's not necessary.
And on a similar note, you've also discussed the mortgage stress tests, which were introduced in 2017 by CMHC and OFSI, our banking regulator, which requires borrowers to qualify assuming interest rates as high as almost 5% when rates are currently in the 2% range. And I'm wondering what you think of those tests, especially given the type of messaging we've just heard from the Bank of Canada.
Well, this is a hammer I've been banging away with for a long time now. The idea of stress testing, of course we want stress testing. We want to make sure that people can afford to make mortgage payments. And we want to make sure that they have reasonable contingencies, ability to handle reasonable situations that might arise in the future. So the test we have now is not a reasonable test of what might happen in the future. To use a 5% interest rate, when I think there is not a very large body of people who are saying we're going to see 5% mortgage rates in the next 2 years. I think it's pretty clear we're not. So it's one thing, the interest rate is too high. The second problem I've had with this is that the test is for a mortgage renewal that's going to happen in the future. Get your mortgage today. Most people are going to renew it in 5 years. So the test is about your ability to afford your payments in 5 years. So there's one assumption made that interest rates are going to be vastly higher in 5 years. We've talked about that. I don't agree with it. But an assumption that is missing is what's going to happen to people's incomes. We have many, many years of data show that incomes rise every year. Over the past 5 years, incomes in Canada have increased by 12 or 13%. So when you renew your mortgage in 5 years, you're going to have 12 or 13% more income to apply to that mortgage. The stress test is not taking that into account. And I think that's a really major flaw in the methodology and the policies that needs to be adjusted.
And so if we do see these tighter credit measures, obviously CMHC's other lenders didn't go with them. So that had a bit of a limited impact in terms of the July 1st changes, but obviously the stress tests have had a prolonged impact on the market. Do you see them impacting our economic recovery? I mean, it's a bit funny because on the one hand we have these restrictions, but on the other hand we have this really low interest rate environment for the next few years. So I'm wondering how you see that sort of balancing out.
Yeah, well, I think the interest of the government is and should be, if I'm reading this right, the interest should be in developing policies that are positive for promoting economic recovery, but do not create in themselves new risks. Okay. So we have, in the mortgage space, we have economic policies that are actually creating the wrong kind of risk. They're not creating risks to the economy, they're creating a risk of an underperforming economy. So I would say that there probably is some kind of improvement to the mortgage stress tests that will not worsen the economic risks, but will at the same time contribute to a better economic recovery. And certainly improvement of the stress tests has to be up for discussion. To what extent can the stress tests be loosened to responsibly and a reasonably risk-free way to contribute to more home buying, which will contribute to a stronger economic recovery? I hope that makes some sense.
Yes. So the idea is that maybe more optimization is possible there.
A bit. No. Can you see my hands? A lot. I mean, we do not need a stress test interest rate of 5%, and we do not need to ignore income growth. I mean, I've been saying for a long time, and I'm still saying it, what the stress test should be to take account of time and income growth. The stress test should be based on the contract rate plus 3/4 of a point. And that formula provides a lot of room for, somebody who can pass that test. It's going to have a lot of room to deal with any situation that we can reasonably expect to occur when they renew their mortgage in 5 years. So contract rate plus 3/4 of a point, I believe, is a good risk management policy for the stress tests.
Now, Will, you've been, as I mentioned, looking at housing markets for a long time.
Yes.
And I'm wondering what our previous experiences of Canadian housing market downturns might tell us about today, if anything, given your earlier comments. The last time Toronto's housing market saw a crash in prices is in the early 1990s. Can you walk us through what the market was like in the 1980s leading up to that?
Okay, I'm going to have a lot to say about this. Okay. I was working as a professional housing market analyst at that time with CMHC. Now, that period started sometime in 1985 and ended sometime in 1989. I was there for the beginning of it. I actually moved away from Toronto at the end of 1985. I purchased a house actually November of the year before. So I sold a house that I'd owned for 14 months, and I made 25% on that house. Okay. That's the boom period. We had a 4-year period in which house prices in Toronto rose by an average of 26%. Okay. If we've ever had a bubble in Canada, this would be the first candidate to call a bubble. So I think I'm going to segue a little bit and talk about what I think is meant by the term bubble. It's a word that gets thrown around very freely, and a lot of people, when they see house prices rising rapidly, they immediately leap to the bubble word. But I don't think rapid price growth is the necessary condition, sufficient condition. The dog is growling behind me. Can you pick one up on the mic? Okay. If it does, let me know and I'll do something with the dog. Okay. So what are the conditions for a bubble? Well, first of all, prices being driven by expectations of prices. It's a short circuit in the housing market. People expect prices are going to rise very rapidly, and so they go out and buy it, and they cause the rises to happen. And that was very much in place in that boom period. We call it the boom, from 85 to 89. That, the narrative in the community at the time was, you're never going to have another chance to buy. You have to buy now, even though it's horrible. You got to do it because it's going to get even worse in the future. That's pretty stereotypical behavior. But there's a second element that even though prices are rising, there may be a good reason that prices are rising. Objectively solid reasons coming out of the economy. So one has to ask oneself, are there reasons why prices should be rising the way they are? And there are actually times when prices rise very rapidly for very good reason. That boom period, prices rose very rapidly, but not for a very good reason. It rose because they rose. There wasn't a real economic driver. Having said that, prices were rising so rapidly, and people were feeling so rich. The economy was the strongest it's ever been in the entirety of history for the Toronto economy at that time. The percentage of people who had jobs was the highest ever, and we're never going to get back to that. 70%, they were in the low 60s. Okay? So it's a wealth effect, a very powerful wealth effect to the economy. And then that job creation is stimulating even more housing demand. So we got into this self-reinforcing upward spiral in the housing market, which, in retrospect, was not sustainable. It was not justifiable. One thing I did recently, I've never actually published this, this part of the analysis. I do analysis sometimes that looks at the cost of renting versus the cost of owning. To me, that's the primary economic fundamental to determine whether or not a housing market's in a bubble situation. So I look at rent, I look at housing costs for ownership. As an aside, I make an adjustment there. Part of the mortgage payment is repayment of mortgage principal. So I take that out because it's a form of saving. So the ownership cost is the interest part of the mortgage payment plus taxes, utilities, and the other things you pay. Compare those to rents. And over time, they actually match reasonably well. I mean, there are differences. They match reasonably well. There was a really gross mismatch. House prices and rents were really, really far out of step. There's a huge gap between them. So that's very strong evidence for that period of housing market being detached from economic fundamentals. So two definitions for a bubble, both of them satisfied very, very strongly. If there ever was a bubble in Canada, that was it. Actually, I looked some of that stuff up in a paper I wrote in 2014, which is on my personal website. It's called How to Dissect a Housing Bubble. And it's dated now, but I think there are some messages in it that are still relevant. So anybody who's got interest in this topic, I would encourage you to read the first page plus the bullet that goes over onto the second page. And of course, you'll be so fascinated you want to read it. Okay. So what I concluded in 2000, we'll get back to the boom, okay? But what I concluded in 2014 was, no, we don't have bubbles in Canada. In general, house prices are very well aligned. When you look at the carrying costs, very well aligned with rental costs. So we don't have bubbles in Canada in that perspective. Okay, let's go back to the boom. So, it's a very concerning period. I was living in New Brunswick for most of that period, and it's fascinating to watch it from a distance because the Brunswick housing market did not do the same thing. What can I say? I mean, everybody everywhere else thought, this is silly, this is stupid, this is insane. And eventually what happened to end it was the inflationary pressures came of concern to the Bank of Canada. So mortgage interest rates had been at 10%. Imagine that, 10% mortgage rates. But then they rose to 14.25%. That very rapidly went into, we had a self-reinforcing upward spiral. We went into a self-reinforcing downward spiral, caused prices to fall by about a quarter over a period of 7 years. So can we take away anything from that? Yeah, it's horrible when bubbles happen. Be careful about how you manage them, because the interest rates stayed too high for too long and caused a reduction in housing activity and economic activity. It was much greater than would have happened if there'd been more nimbleness in the policies. Of course, this is all in retrospect. It's easy to say many, many years later that they waited too long. Time probably looked like responsible policy. And for the mindsets that existed at that time within the Bank of Canada, I mean, there's a very different mindset of the Bank of Canada today than there was in 1989.
And was it less conservative at that time, or what was the difference in the mindset then?
I'm having trouble remembering. I mean, there was a very keen focus on inflation. I mean, there always has been. It was before they adopted formal inflation targeting. So it was kind of loosey-goosey until it wasn't anymore. And now there's much more watchfulness of the indicators watching for inflationary pressures. So we see faster adjustments, smaller adjustments happening because of that watchfulness we have now than we would have seen in prior decades.
So, Will, one concern we hear about is that Canada has a very high household debt ratio compared to other industrialized countries around the world of 176%. This ratio was closer to the United States up to 2008, and interestingly has really grown a lot faster than the US. And I'm wondering what you think about people who point to that factor and think that that points to a bubble-like condition, as well as another factor, which is that our incomes don't quite explain how we're able to afford the prices of homes in cities like Toronto and Vancouver. And again, right, those people suggest that might point to a bubble-like condition.
Okay, there's a lot to unpack there, and you'll remind me of points that I'm missing in my discussion. It's true we have a very high debt to income ratio. So where we are on the list actually depends on which list you're using. If you're using the G7 list, we're at the top of the list. But if you use a whole world list, there are actually a lot of countries that have even higher debt ratios than Canada has, including some of the European countries. Mature, developed economies in Western Europe often have higher debt ratios than Canada. That's all beside the point. I mean, the real issue is, can we afford the debt? That's one of the real issues. And there's another set of data from Statistics Canada that looks at debt service ratios. And the debt service, what percentage of incomes are being used to repay mortgages and other debts. And it's a little bit high in historic terms. One of the reasons it's high in historic terms is because the percentage of payments that is going towards mortgage repayment is really enormous. At low interest rates, you repay your mortgages very rapidly. If you look at the interest-only component of debt service in Canada, it's still really low. It's still at a very healthy level. You take some discussion away from that. So, because there's so much principal being repaid, if we become worried about it, why don't we just slow down the amount of principal repayment? If we're in a crisis situation like we are now, it would be a healthy thing to do to just say, let's not worry so much about the principal. So that's one thing to say. The other thing is risk. There's an aggregation problem here. Can I call it that? An aggregation problem. We have a huge amount of indebtedness. Those debts are being taken on by individuals. Now, if it's a problem, it would be because those individual decisions are irresponsible. So do we have evidence that people as individuals are making bad decisions? I'm not persuaded we are. I've tried to get a handle on it through some survey work that I've done through the Mortgage Professionals Canada Association, which is my largest and best client. Okay. So, we've tried to ask consumers questions to get at their mindsets and decision-making processes. So we've asked them, give you a list of 18 factors you would possibly consider when you buy a house. How much consideration do you give to each of these? The ones that are really important, you're giving really high scores to them. Like, how much is my payment? Gets a really high score. What might happen to my interest rate in the future? That gets a really high score. I mean, people are not making, random instantaneous decisions. They're making careful decisions after a lot of thought. So what we've done here is came up with a list of 6 life decisions, and knowing that some of them are more difficult than others, okay? And ask people to rate how stressful is it to make each of these decisions. And I didn't know what to expect. But what we found was that the most challenging one is deciding to move to a new city for career opportunities. But only slightly behind it, especially for the younger age groups, is deciding to buy a home. This kind of blew me away. Deciding to have children is less stressful than deciding to buy a home. And deciding to get married is much less stressful than deciding to buy a home. So, we combine these responses with the other responses on what are the factors you consider. People take buying a home very seriously. It's not a flippant decision. So, people are putting themselves in a situation where they can make good decisions when they buy a home. And I think there's a very large majority of people who do make good decisions about buying a home and about their future ability to fulfill their obligations. So, I think in the mortgage book there are some mistakes in there. Some people make bad decisions, but there's an enormous majority of people who make good decisions. And so from that point of view, the debt to income ratio we have in Canada becomes less concerning to me. Something else we found in our surveys related to flippancy or improper motivations for buying homes. Once in a while, we've asked people, for your home, to what extent is it a place to live versus an investment? Okay? Give us the 2 percentages to add to 100. So what we're finding time after time when we ask this is people say a place to live is 70% or more, and an investment is 30% or less. And that is common, across geographies, across countries. It's similar in the highest price markets as it is in the lowest price markets. And it's similar for older age groups and younger age groups. It's similar for people who are expecting to buy in the near term versus people who bought a long time ago. So, is 70-30 the right ratio? I don't know what the right ratio is. Its value as a dwelling versus its value as an investment. But housing is an investment to some degree. Everybody knows that. I've got a feeling that 70-30 is probably a pretty healthy ratio. It tells me that people are making complicated decisions on a reasonable basis. In my mind, I'm seeing more and more evidence that says there's a lot of mortgage debt out there. There are high house prices out there. People are making decisions based on, I'm better off in this decision than I would be in a lifetime as a renter. In most situations. And I did another report actually that looks at that, called Owning versus Renting. It's about 2 years old now. I produced it for Mortgage Professionals Canada. Anybody who's interested. But what it shows is, in a very large majority of situations, even from day one, you're better off owning than renting. And once you've been in that dwelling for 5 years, virtually everybody better off as an owner. Because once you're in a home, some of your costs go up, like your taxes and utilities and insurance go up, but your mortgage payment is flat. So the total cost of home ownership rises fairly gradually, whereas the cost of renting rises more rapidly. So this, it's a crossing function. Home ownership becomes more and more advantageous for renting the longer you're in your dwelling. By the time you've repaid your mortgage, you're in retirement. The cost of living in your own dwelling might be only 1/4 of what you'd be paying. Okay, enough on that. Something else you wanted to talk about?
So the concern that some have, and I think you touched upon it even a little bit in the 2019 report based on consumer data, is around this idea that while our incomes may grow, we're not always the best at forecasting increasing costs in our lives as well. I think your note reported that a surprising number of people forgot to account for the rising cost of childcare or transportation costs. So what do you say to that argument that, and I think your report also touched a little bit on the fact that those who chose to buy were a little bit more optimistic or appeared to be more optimistic about their income prospects than those who didn't. And that those things coupled together lead to concerns that we don't always think as clearly as we maybe should or might like to when we're making these kind of decisions.
Okay, I want to step back to the beginning of those comments about childcare. To me, that part of the research was actually, let's call it a growth experience, because I learned something that I had not anticipated would happen. So not everybody who buys a home has a childcare expense. And so the way we set up the survey did not allow me to separate people who don't expect to have children, those who do expect to have children. So when I say on average, people don't give a lot of consideration to future childcare costs, I can't honestly say whether or not that's a real problem. Because people who don't have children, I'd expect them not to give consideration to that cost. And I don't know to what extent people who have children or expect to have children give it enough consideration. I honestly can say I do not know whether or not you're adequately addressing the question. As an individual who is a parent, say, give it at least some, okay? But again, I don't know if they gave it enough. But in the broad scheme of things, in other questions where it's unambiguous what the data is telling me, data is pretty clearly telling me this was carefully considered. In the area where the data is very highly ambiguous, saying there are hints, but I can't draw a conclusion. I'd like to be able to. I'd like to be able to say people are making mistakes or people are fine, but I honestly cannot answer that.
If you, and you've said that you don't believe we're in bubble territories, what do you think is the biggest factor driving the high home prices in Canada overall?
Okay. I'm going to qualify that a little bit. In my neighborhood, there's a real estate agent who provides me weekly sales. Okay. And I go through those, and I always notice a few silly prices. Okay. Most of the prices are more or less what I'd expect them to be, within a few percent. So, it looks like most people are making reasonable decisions for the market we're in. A few people are making mistakes in the markets. So there is some behavior that might look a little bit like a bubble, but it's on the margins of the market, as far as I can tell. For the most part, the few people making silly decisions, if I'm characterizing that correctly, are not resulting in a huge macro defect in the housing market. They're resulting in personal defects they're going to have to deal with in their own circumstances. As long as it's only a little bit of that activity, it's not a systemic risk to the economy of the housing market. So I'd say, even though there's some silly behavior, it's not a bubble situation. We still are pretty attuned to the fundamentals. And as far as I can tell, for the most part, the psychology is not that I got to buy or I'm going to die. I can buy in my situation, so I will make a good decision in my situation.
And the second part of that, overall, what do you think has led to that price growth that we saw in that indices from, I think it started in, I can't remember when your chart started, but what do you think the big driver of that growth has been?
Okay. When I did that report in 2014, How to Dissect the Housing Bubble, I drew a conclusion based on the data we had on rents, prices, and interest rates. At that time, there's actually room for prices to rise in Canada by 20 to 25%, just based on the affordability of ownership versus rent. Right? As an aside, I got a fair amount of flack for that at the time. Only once in my career have I gotten hate mail over something like this. I got hate mail over that. So it goes. I got big strong shoulders, so not really. So we're in that same situation today. That low interest rates have created space in which house prices could rise if market circumstances permit prices to rise. So we're in a situation of pretty good affordability, constrained supply, so people can afford to offer higher prices to their houses. It's a hyper-competitive housing market because of supply and because the interest rates we have facilitate the ability to offer prices. So, there are places in Canada that have the same interest rates, but do not have the same rapid price growth because they've got the supply. I wish we had the supply in Toronto. Everybody is still saying we need more supply in Toronto. It's still an issue for years and years to come. In a situation of relatively good affordability and constrained supply with some price pressures, we're going to see very competitive markets with multiple offers, price bid ups.
So that brings us nicely to my next question, which is the theme of our summit is smart caution. What does that mean to you?
Well, it means that's exactly what people are doing. That's what I've been talking about, isn't it? People making very important decisions very carefully, very thoughtfully, and really agonizing over the decisions they're making. For the most part, a very, very large majority of people are doing exactly what you're advocating. And I don't see that changing. Anybody who can afford to buy a house, well, almost anybody who can afford to buy a house has a good education and has the ability to do problem solving of the kind that is required to make a good decision in the housing market.
And our final question, which we're asking all our guests, is would you buy or sell a home right now?
I probably wouldn't, but why? My personal circumstances dictate that I'm totally happy where I am, and just a lot of uncertainty about my income. My income is project-based, one project at a time. I have no confidence in my ability to forecast what's going to happen to my income over the next year or so. But that's a very, very personal decision, which was not generalizable to most people. See this. So this is a way of me saying I really don't like giving people personal information, except that you just need to be really careful. And I know you're going to be.
Great. Thank you so much for joining us, Will.
This has been a great conversation. I've enjoyed it.